Sam Bankman-Fried was one of the largest political donors last midterms. If we look at the list based on donor size, we can see that SBF comes in at number 4 as one of the biggest donors behind Jeffrey Yask and Kenneth Griffin. If we look at the parties that he actually donated to, we can see that he was heavily skewed towards donating towards the Democrats. We can see this as highlighted by the blue, although he did make a few Republican donations, but he was heavily skewed towards the Democrats in terms of where he was donating money. Now, he was donating a lot of money off the back of a very strong FTX balance sheet, or so we thought at the time, and he clearly was putting up a show of strength, donating to all these parties. Clearly, he had a vested interest behind these donations. However, now that FTX has declared bankruptcy and now that creditors are owed money, they have a bit of a situation. They've donated all this money out to all these political parties, and now creditors are saying, no, hold on, we need our money back because we're owed money. We can't even withdraw our funds from FTX. So now they're in a weird situation where they actually have to take their money back from the donations from these political parties to pay our creditors. And this is the process that SBF and FTX announced that they would start doing today, and that is clawing back donations to politicians and charities. So FTX, the collapsed cryptocurrency exchange founded by SBF, has started trying to claw back payments made by its former management to politicians, celebrities, and charities as it continues to progress through bankruptcy proceedings in the US. FTX intends to commence actions before the bankruptcy court to require the return of such payments, with interest accruing from the date any action is commenced. So in today's show, we're going to be looking through the donations, and we're going to be looking through what exactly is happening with this clawback. And then I'm going to give you guys a case update, because we did get big news from the SBS case in terms of his extradition hopes to the US today. And there was even rumors that he was sent to hospital, which we're going to run through. And then we are also going to go through a major market update off the back of the Bank of Japan raising its interest ceiling, as well as the Ethereum and the Bitcoin charts, which actually did break out, however, are still at a very, very key, decisive level. So smash that like button if you're looking forward to the show. And without further ado, let's get straight into it. So, in criminal charges filed in the state of New York, the Department of Justice has alleged that the donations were the result of criminal money laundering, since the money was effectively taken from customer accounts. So we know that SBF didn't have the full right to 100% of the funds on the platform. And when he was making donations, it was highly likely that he was using customer funds in order to make these donations to the Democrats, as we could see exemplified by this list of donations that he made here. So the charges also allege campaign finance violations, arguing that Bankman-Fried and others known and unknown broke donation limits by making contributions in the names of other people. So even breaking the threshold in which he was allowed to legally donate. Clawing back payments made to politicians and charities is likely to be one of the easier parts of the bankruptcy process, because we know that this process is going to be extremely long, extremely drawn out. If we know anything from other bankruptcy proceedings in the past, from other companies, other entities, even look further back to this year to like BlockFi and Voyager, we know these processes take a long time. They're saying here that the clawback of political donations will probably be one of the easier processes, considering creditors are owed a lot of money from other areas of the business as well. So under US law, payments or transfers made within 90 days of bankruptcy are presumed to be preferential if they result in a creditor getting more than it would have been entitled to at the end of the bankruptcy process. And a clawback can attempt to recover the difference in payments. With FTX, which it obviously lost between what we think is an estimated $8 billion and $10 billion from consumer withdrawals in a day and less than a week before it declared bankruptcy, there could be millions of dollars that the court decides were distributed unfairly. So the court will have to make a decision as to what funds were and what funds weren't distributed fairly. However, it is highly likely we are going to see FTX, and they have already alluded to this, demanding a refund on the donations that they did make to these political parties. Now, obviously, if you're a political party, you don't want this money. It's considered in the eyes of the financial industry and the general public kind of, to an extent, blood money. So if you've taken a donation and you're a political entity, it's in your best interest to return it, or at least conduct the process of returning the funds, or state your intent to return the funds, because it is, I guess, dangerous from their perspective, from a public perspective, to kind of keep this money if it's owed to creditors throughout bankruptcy proceedings. So we've already seen this happen. as the Democrats' Senate Majority PAC, which is a committee, plans to return $3 million in donations from disgraced former FTX executives. So we've already seen some parties come out and say that they're going to be returning the funds that they received from SBF and FTX. So the pro-Democratic Senate Party plans to return $3 million in donations, and also not only from SBF, but from Nishad Singh, another head executive at FTX, the group said on Tuesday. The Super PAC, which spends more than $160 million supporting Democratic bids for Senate seats, received $2 million from Singh and $1 million from Bankman-Fried during the 2022 election cycle, according to Federal Electoral Commission records. So Bankman-Fried also, not only that, $3 million, donated $6 million in April to the House Majority PAC, which raises money for Democrat candidates running for the lower chamber, according to the FEC filing. The PAC said that they will send funds in question wherever authorities instruct us. So it's highly likely that we do get instructions from authorities towards these entities to actually start returning funds as part of both legal litigation and the bankruptcy proceedings, which are obviously set to kick into gear soon. So very interesting that they are demanding refunds. It makes complete sense. They do need to pay out creditors, and that just kind of adds another twist to the tale here, because what we're going to start seeing over the next few weeks is who exactly Sam Bankman-Fried donated to, with all these parties coming out and revealing exactly how much they received and exactly how much they sent out. Although we do have leaked documents of the amounts that Sam Bankman donated, we are going to get even more clarity and even more entities possibly entering the fray. So it just adds another complication to the SBF saga, of which, by the way, is seems to be developing at a rapid pace. So I'm going to update you on exactly what is happening in the Bahamas right now. So FTX founder Sam Bankman-Fried's lawyer was the only one to attend court in the Bahamas. So if you guys didn't know, today SBF was scheduled to attend court, or at least rumored to be attending court, to file his extradition. He went to court yesterday to file extradition, and there was a big confusion because SBF in the courthouse himself said that he wanted to file it, but his lawyer stated that they didn't realize any intention of SBF filing an extradition request to the US, and that they actually would require more details from the court to process this request. So it was really weird because it ended up causing a lot of confusion in court, and the judge ended up sending SBF home, or back to jail in this case, because there wasn't enough concrete evidence or enough concrete details to send him back to the US. So what happened was they postponed it to the next day, in which just his lawyer attended in order to process filings that Sam Bankman-Fried intends to file for extradition to the US. So FTX Sam Bankman-Fried today signed extradition papers as Wednesday's hearing looms. So he signed the papers, his lawyer went into court to drop them off, but SBF himself wasn't present. He will be present in court tomorrow. So he does obviously face huge charges in the US, and he's also facing criminal charges in the Bahamas. By all intents and purposes, the Bahamas conditions aren't too good, and Sam is requesting extradition to the US. There are also a lot of US officials that want to see Sam jailed and tried in the US and not in the Bahamas. Although I think a lot of people do want to see Sam run in the Bahamas. It's basically 100% confirmed now that he will be heading to the US, but we do need to wait to see what plays out tomorrow in court. So tomorrow he will face the Bahamas Magistrates Court at 11 a.m. EDT, or Bahamas time, and that is when we are obviously going to get some more clarity over whether the extradition is official or not. For now, he's filed the papers and he's still in the Bahamas. Weirdly, though, people were saying that Sam Bankman-Fried was sent to hospital today. So we saw this leak from the Bahamas Press, which is a news outlet, clearly a pretty shocking news outlet, because they posted a photo of a doctor's hospital and said, breaking, BP's now learning a senior high-ranking police officer has presented himself at the hospital today. And there was a lot of speculation as to whether this was SBF. And then rumors started doing the round that SBF was sent to the doctor's hospital. Now, these rumors were dismissed, as Rob Copeland said that the head of the prison tells him a few moments ago Sam was actually eating lunch and was held there in a medical bay, which has been held in a single room with 4 roommates. So basically confirmed now that Sam wasn't sent to hospital, but I I was like half asleep in the morning at 2 a.m. and I opened my phone. I was seeing all these things like Sam Bankman-Fried suicide attempt, Sam Bankman-Fried in hospital. I was like, what the hell has happened here? But obviously it turned out it was just rumors on Twitter as the typical Twitter rumor mill kicks into gear. So that's obviously not the case, but we do have to keep our eye on tomorrow's case at 11 a.m. He could be in the US as soon as tomorrow night if they do end up filing proceedings here and approving his extradition to the US. So let's just see exactly what happens on that front. And of course, crypto mass adoption is here. We are finally on the front page of the Wall Street Journal, guys. We finally made it. Crypto is at the top. Oh, wait, it's just more Sam Bankman-Fried stuff. So the mass adoption we wanted ended up just being more crypto FUD on the front page of the Wall Street Journal yesterday, which is kind of crazy now, the whole crypto industry. And although like there's a strong argument to be made, this is not even a crypto fraud at all. It's got everything to do with human greed and nothing to do with decentralization. Still, crypto finds itself on the front page of the Wall Street Journal today, as Sam has really taken the world by storm, and this story has been picked up, and rightfully so, because a $10 billion fraud in the context of history is one of the largest frauds in history, and to have unraveled the way it did, it's been kind of crazy proceeding. So it does make sense it's getting coverage, but crypto not on the front page for the right reasons. Okay, let's get on to the rest of the show. Major market update. Because the Bank of Japan sent shockwaves through the market yesterday as they raised their target here on interest rates. So I'm going to go through exactly what this may mean. There's a good thread that Macro Alf wrote that I thought gives us a lot of great clarity over how this could potentially implicate the US and the decisions of the European Central Bank. And then after that, I want to talk about how the markets are responding based on the current prices and the levels that I'm seeing, the Ethereum dominance, etc. And then also at the end, I'm going to answer some questions in Q&A form and have a chat to you guys, because I've been doing the Instagram Q&As, but I thought today it might be nice to just do it on YouTube and answer some of your questions and get to talk a bit of crypto alpha with you. So the Bank of Japan recently maintained a minus 0.1% target for its short-term rates and a 0% target for the 10-year bond yield. But what caught markets by surprise was the widening of the band around its yield target to 0.5%. Part of this move allows its 10-year bond yields to rise to around 0.5%, which is an upward adjustment from the previous upper limit of 0.25%. Being one of the few central banks to maintain its dovish tone amid tighter global financing conditions, today's adjustment to its YCC policy seems to add a tint of hawkishness to the central bank's tone, seemingly laying the groundwork for an eventual rise in interest rates. Market rate hike expectations have reacted accordingly to the news with an earlier time frame for rate hike in 2023, and we can now see the expected hikes based on the current basis point levels for interest rates in Japan. So what does this mean? Well, it means that Japan, which was previously taking quite a dovish response, so a soft response to monetary policy, is now tightening up, and they are taking a more hawkish approach by raising its yield target 0.5%. Now, the Bank of Japan is one of the biggest traders in the Forex market worldwide. And we see like a lot of trading pairs, like the AUD Japanese yen actually crashed yesterday. So it has had implications on Forex, but it also likely has implications on the US and other around the world as they look to adjust their policies as well. So I want to break down the key points from Macro Alf's thread, because he does a much better job explaining it than I do, since he is a macro expert and I'm very much more crypto focused than macro focused. So he said Japan will now allow 10-year yields to trade as high as 0.5%. And while this seems like a minor policy change, it's likely to cause some serious market volatility. Why? Because for years, Japan implemented an aggressively dovish monetary policy stance. Bank of Japan rates were effectively pinned at 0% for decades. Large-scale quantitative easing was standard practice, and a few years ago, the BOJ switched to yield curve control. So they were easing for a long time. This was necessary as permanent QE quantitative easing led the Bank of Japan to own more than 50% of the Japanese government bond market, and buying more bonds would seriously alter the functioning of the market. For days, there were basically no trades happening in the Japanese government bond market. So to keep these 10-year yields low, so the yield of treasury bonds down. The Bank of Japan moved from targeting the quantity of bonds to a qualitative measure, which is the YCC. And it succeeded because over the last 6 years, 10-year Japanese government bonds traded between minus 25 and plus 25 basis points like the bank wanted. But why does this matter? Because Japan is a huge exporter of capital. And this is why it has ramifications worldwide, because since the 90s, Japanese investors are used to look abroad for opportunities to deploy their domestic excess savings, for example, the US. When doing so, they consider both yield differentials and the cost of hedging for foreign currency risks. For instance, as of July 2022, Japan is the largest holder of US treasuries in the world. So Japan, out of every single country, owns the most US treasury bonds of any other country, because that's where investors look to park their assets to get yield. If yield is superior overseas, if the rates are higher overseas, obviously they're going to park their money overseas. But what he's saying now is that since they have raised the threshold, we could see treasury bonds slightly increase in yield in Japan as they've raised the target, which means that investors are less likely to seek options abroad because they can get better rates or similar comparable rates in-house, which is more tax efficient. So Japan has accumulated over $1 trillion in US Treasury bonds as it's a convenient way to recycle excess savings. Yield differentials were positive and even more of offsetting the cost of hedging USD Japanese risks, which is also a risk when you're denominating investments in your local currency. The chart below shows how convenient it was for Japanese investors to buy treasuries and cover the FX risk. They would get an average 100 to 150 BPS additional return than buying domestic government bonds. So what he was saying is in the past, they would get a 100 basis point or 1% benefit to holding international US treasuries rather than holding their own Japanese government bonds. But now, Kuruda announced that the 10-year Japanese government bond can now trade between -5 and +5 instead of +2.5, which is a raise of 25 basis points, hence widening the band for YCC. This is what bond futures thought about it. Obviously, they tanked. It was a true surprise, but why did he choose to do it now? Because core inflation's rising, so QE is no longer a strategy which they see working. With inflation rising very, very quickly, they need to do something to dampen inflation in the short term. One of the easiest way to do this is implement restrictive monetary policy, and obviously raising the target on treasury yield is one way to do this through hiking interest rates. Many analysts expect it to be stable around 2% in 2023. After years of relentless easing, Kuruda can likely claim job done and set the stage for his successor to set a new monetary policy in 2023, a victory lap if you wish. Let me show you what the bond market really thinks of this BOJ decision. While economists and policymakers are more convinced inflation will sit at 2% in Japan next year, inflation swap traders disagree. 1% CPI priced in late 2023 and beginning 2024. So, essentially, what is happening is one of the largest capital exporters in the world, Japan, the largest holders of US Treasury bonds, are now deciding to domestically reward savings with higher interest rates. And obviously, this means there's more macro consequences as there's less investors from Japan that are now going to invest in overseas markets. Also, it does set a precedent as it strengthens the yen, negatively affects foreign assets as they hike rates and implement a more hawkish policy. So I think this had pretty big ramifications yesterday. It was one of the major reasons the market dumped and then the market pumped. I'll get into why the market pumped in a second. And obviously this just kind of changes the picture a little bit as this macro situation is very adaptive at the moment. So we need to see how the BOJ decision plays out. As a summary, I think Duo9 did a good job. He said for decades and until today, anyone in the world could go to Japan and borrow yens for free, almost zero interest rate, and use that to get risky bets with better returns. That ended today. No more cheap money /QE. This might highlight the issues. Japan spending 66 more than they are on taxing citizens. Japanese debt, 12.8 trillion, 0.182 trillion, which would represent 23% of Japanese tax revenues, and Japanese deficit is now per dollar 0.40 trillion or 65% higher than taxes. So Japan also has a debt problem. This isn't just exclusive to Asia, though. This is also widespread across many Western countries, obviously the US included in that. So let's look at the market, how the market's responded, and what to look at the moment. I just wanted to highlight this thread. I thought it was pretty good. Bitcoin Jack said these are the things to follow at the moment. Right now, there is kind of a drying up of crypto-specific narratives and a lot of big, wider picture macro narratives which are playing out. And these are the narratives which are going to dictate what ends up happening in Q1 next year. Obviously, the rate hikes and Jerome Powell and the US's response and how whether CPI keeps coming down is probably the biggest driver right now behind equity valuations. However, it's also important to note the DCG situation, which I talked about on the weekend. That's a big crypto-specific issue. A potential bankruptcy there would mean the liquidation of more assets, so we have to keep our eyes on that. How the FTX situation is played out with existing capital, existing positions. Obviously, they have a lot of locked capital in crypto as well. Grayscale versus SEC will have a big impact on the future of the Grayscale Bitcoin Trust, because if they're able to have a spot ETF, that means they can implement redemptions, which makes it a more attractive proposition to own Grayscale. Obviously, the more money invested in Grayscale, the higher their management fee. That could solve a lot of their issues, but clearly they can't redeem GBTC right now because of the ETF block by the SEC. So that's a big narrative as well. Silvergate class actions, a federal investigation into crypto and more exchanges. All of these are headwinds and also potential catalysts heading into next year. And I'd also add on top of that, probably the XRP case. So keep an eye on this tweet. Keep an eye on some of the other things I mentioned, because Q1 is going to be busy. I do expect a cooling of news over the holiday period, as that's typically what happens over like the next few weeks or so. But then I expect Q1 to really ramp up. So enjoy the peace if there is any, because next year is the year of regulation, and it's going to be also the year of many major regulatory, but also crypto-specific unravelings. So let's keep our eye on that. All right, now onto the charts, the fun stuff. Let's look where we currently sit ahead of all this drama. Now, I said yesterday that there's two key levels that I'm looking at. There's the level here, and I'm using Ethereum to substantiate these levels before I head over to Bitcoin at 1170, and then there's this key level at 1300. Now, this is kind of my long and short zone. We are currently range bound, and until further notice, this is the range that I'm trading in. So whenever we hit the bottom of this range, as we were in yesterday, I'm looking at longing, and whenever we're at the top of this range, I am looking at shorting. Now, these trades are what I would consider beer money trades. This means smaller size because we're playing a much tighter range. Now, obviously with leverage, you can still make a lot of money, but it's a 10% range top to bottom. Clearly, that's a big range, but it's not like gonna make life-changing money, this range. Of course, if you're using like proper leverage and proper risk management with stop losses, that's not where the big moves come. The big moves actually come when we break out of this range. So if we break to the downside, we have those $1,000 price targets. If we break to the upside, we see similar targets going the other way, up until the 1600 level. So right now, Ethereum has a very key decision to make, and it's whether it can break out of this range or not. And these are the key levels that I'm currently identifying. So until we get major confirmation in either direction, then I would be strongly considering just trading this range. So if we come back down and test this level again and we get a confirmation, then of course you can go long and set your stop just below the previous liquidation at 1148. That's a pretty low risk, low, where you don't have to risk much of your capital kind of trade. And then to the upside to the downside as well, if we keep pumping, maybe it's worth just missing out on this next few percent, waiting until we hit a stronger resistance level. I'd say this entire zone is fairly strong resistance. We can see that we kind of bounced off that 6 times previously throughout the whole of December and also the end of October as well. This would be a decent level to short Ethereum. Now, when I look at Bitcoin, I'm seeing a very, very, very similar pattern. I'm seeing the range as well. I'm seeing the exact same thing, except Bitcoin's levels respectively are 16,372 and also on the upper band, 17,357. Now, Bitcoin did break out and had a huge pump pre-CPI, but then we came back straight back into the range and bounced off this bottom zone after the FOMC. So Bitcoin and Ethereum are very, very similar right now. My trades remain the same, longing at the bottom of this range at 16,372 with a stop under the previous low, which is around 16K, a bit lower. And then also shorting from the top of the range, 17,351, is kind of the level that I'm looking at right now until we get our massive rent money trades, which are obviously the breakouts to either side. This would take us up to the range low at 18.5. That is a possibility. And this would also take us down if we broke to the downside, first to the range of 15.7, but also down to 15K as our next key zone there. So in terms of Bitcoin and Ethereum, there's no need to overcomplicate things right now. If you want to long, you long Bitcoin because the ETH BTC chart is looking quite weak. What this means is that the dominance is in favor of Bitcoin. Although we did see a rally of Ethereum over the last couple of days, in general, this trend is now starting to break down. It is to the downside, which means Bitcoin has the strength in the market. So when we long Bitcoin. That's just the kind of as simple as it is. Also, the inflation hedge narrative, it's kind of, I know it's generally been weak this entire year, but I'm starting to see that bob up a little bit. Could give it enough fuel to kind of get a pump in the short term. So that's why I'm longing Bitcoin versus ETH. But whereas if you wanted to short, so if the market breaks to the downside and you have a choice of what altcoins to short, obviously you're going to short ETH and altcoins over Bitcoin because Ethereum is the weaker coin. So that is my plan for trading right now. Those are the zones. And you guys know if I'm longing Bitcoin. If I'm shorting Ethereum. And that is kind of how I'm approaching trades at the moment. So of course, if you do want to trade, and get involved with any of these trades, as you can see identified by my levels here, then you can do so on Apex. It's a decentralized exchange. You don't need to worry about exchanges keeping custody of your assets. It's run on layer 2, so using ZK rollups. Also, they're giving out like a lot of rewards in their native token Banner for people that actually trade. So you can actually earn money when you trade, and not just a little bit. Like their reward incentives are huge. I think it's $190,000 a week. So millions and millions and millions of dollars throughout the year they're going to be giving away to people that trade because they're a new exchange. They just partnered with BYBIT, and right now the incentives are really high. So for me, given the next DEX narrative in tandem with the rewards they're offering, it just makes sense to trade on Apex. Also, they just implemented custom leverage and a custom stop loss. So thanks to Apex for sponsoring the show, obviously. And also, if you want to take those trades, you can do so on Apex. Now, what I wanted to do was do a Q&A for 10 minutes because usually I do it on my Instagram after the shows, but not all of you guys join the Instagram, which is okay because I'm happy to just do it here today and answer any questions. So if you have any questions on what I talked about today, drop them in the comments right now. If you have any questions on the overall market, drop them in the comments right now and I will get to the trades. While you guys are asking that question, I want to remind you that I am actively managing my nested portfolios. I'm working on a major update to this Polygon portfolio right now, which will kind of constitute what I view as a decent 1 to 2 year DCA portfolio. Long term, it is quite hard to verify which altcoins will survive if you kind of give it like a 5-year time horizon. But if we kind of zoom things down to a 1 to 2 year time horizon, there are narratives which I think could really outperform. One of which is this order book DEX narrative that I talked about with Jordy last week. I do think that's a very, very strong play. He actually called the layer 1 rotation dead and says that he's much more focused towards what he calls the fat protocol thesis, the thesis that the DApps actually accrue the value rather than the L1. So he's very geared towards finding new DApps. So if you kind of want to learn a little bit more about that, I know a lot of you probably watched it because I debuted the show on Friday, but I did do a summary on my Twitter. There's a link in the description to my Twitter, which kind of summarized the 10 most important takeaways. There's juicy stuff. There's the Bitcoin security model being flawed. There's the flippening that's going to happen, according to Jordy. There's L1s being dead. Eventual ETH and BTC supply squeeze. Oracle dexes like GMX being inferior. Narratives for the future. And when he thinks Bitcoin will bottom. So I know a lot of you guys did watch that on YouTube. But if you do want the shorter, abbreviated thread version, it is also on my Twitter. And this has some very interesting points. As I said, one of which covers narratives, which I'll be actively investing in. And I'm also talking to Jordy about the dexes he's looking at. You know, he said in the interview that he is looking with his venture firm at identifying the projects that could potentially benefit off this DEX narrative. And I am keeping in contact with him. And when I do get the inside alpha scoop and he's okay for me to share it publicly, then, you know, I'll reveal that to you guys and possibly even put it in my portfolio as well, because, you know, he's very clued up. He's got his ear to the ground. He knows a lot about DEXs and stuff. All right, let's go through it. Any thoughts on DOT? I do have a few thoughts on DOT. And by the way, I'll keep all my explanations brief in today's video, like 1 to 2 minutes per question max, because obviously I could go on for half an hour about DOT. One of the really positive things about DOT is its developer ecosystem. It has a very, very loyal ecosystem of developers. Its developer activity is extremely high. And we know that how important developers are in terms of ensuring the success of a project long term, because you need quality dApps. As the Fat Protocol thesis outlines, if the apps are to accrue most of the value in crypto, then we want to be looking forward to the best dApps and positioning ourselves in those dApps, and the ecosystems inherently benefit off getting like better applications built on their platforms. Now, Dot having very strong developer metrics does exhibit this, but there's a few question marks I have about Dot, and this isn't to shit on any project. This is just to kind of label my criticism so we can like look forward toward them and evaluate every project critically. And that's Dot. A is very expensive for new projects to launch on, so it could potentially be a headwind in terms of getting new developers onto the chain. B, not being EVM compatible means that it is going to have a hard time with other applications deploying cross-chain until there are kind of proprietary interoperability plays which can connect chains. We are seeing that with Layer 0, but I don't think it's quite there yet. And then 3, what is the value prop of Polkadot versus some of the other novel approaches to interoperability? Obviously, we've got Cosmos ecosystem being one of them. That's been an SDK that developers have found probably easier to develop on, despite Dot having very strong numbers in that category as well. Also, we've seen a very robust ecosystem being built around Atom. We haven't really seen that around Dot yet. So my major question mark comes off the back of kind of a lack of proof. It has a very good design. It has very good security. It is quite decentralized relative to some of these other chains. Once again, users don't necessarily always value decentralization very highly, but some do, and certainly institutions do as well. But we haven't really seen the ecosystem flesh out in terms of Dot. So for me, it remains a speculative play, one that I might bet on in the future because of the interoperability exposure. However, there probably are better plays in that niche. I mean, just a lot of the Layer 0 DApps, Layer 0 is going to have a token next year, are going to be fantastic that launch. Stargate's one of them. Tokenomics on Stargate aren't the best, but there are going to be iterations with capture value better than Stargate. You've also got Rune as kind of like a cross-chain swapping play. I don't necessarily think that's a competitor because it's not an L1, but it kind of ties into that thesis as well. Cosmos, that's probably the biggest direct competitor, although betting on the Atom token itself isn't great. Are you just better off investing in the Atom ecosystem? All valid questions I have to ask around Dot. But I'm very open to Polkadot because I like its design. I think its approach is very unique. But of course, I have my questions. So that's my opinion on Dot. How are the fees on Apex? Extremely low. That's actually one of the reasons why I think Apex is good. They're extremely low. You can actually look up their fee breakdown online, search up Apex fee document. It'll give them up. It's a lot cheaper than trading on a centralized exchange, or most centralized exchanges, as far as that goes. Crimson says, "What's up with ADA?" I mean, this is a good question. I think I've never been the biggest ADA fan. The reason why I've never been the biggest ADA fan has nothing to do with the tech. It has nothing to do with the product, and it has everything to do with the valuation relative to the product. And I think it's very hard to sit here and say, as a pragmatic investor, Cardano as a top 10 project, given the current metric that we have, is verifiable because it is number 9 on in the top 10. In fact, if you get rid of the stable coins, it's actually like number 6. You can't seriously tell me that Cardano as an L1 is gaining more traction than some of the L2s like Arbitrum, is gaining more traction than Matic, is even really gaining more traction than a Solana. Even Avalanche last bull run was gaining a lot more traction than Cardano. Cardano's just not an L1 that we've seen really flesh out an ecosystem and even really be able to handle mass transactions yet. Like, it only really just launched its mainnet and started getting some DApps. And the development is quite soft on Cardano. But I also do respect Charles. I think he's very smart. So, I don't want to completely fade it yet. It could succeed. But, I kind of view the future as being mostly Ethereum dominant. You've got your L2s. You've got your niche L1s. And maybe Cardano slots in as a niche L1. But it's not overtaking Ethereum. That was the narrative that drove it in 2021, that it was the next ETH killer. That's not going to happen unless something like catastrophic happens to Ethereum. Then that's not going to happen. So that's not driving it anymore. We know that L2s have now kind of taken the hold as like the stronger narrative in terms of when new DApps want to deploy. So we know that it's kind of not really competing with L2. So it just has to fit into that multi-chain future as a niche chain. And as a niche chain, it can succeed. But does it succeed in the future from a risk-reward standpoint of $9 billion? And it's fully diluted of, I think, even higher than that. What is it? $11.5 billion? I don't think so. I just don't think it's the best bet. I think there are higher upside plays higher percentage plays. And you got to remember, whenever you're investing in crypto, it's opportunity cost. Just because one token's great, the whole top 50 could be great, theoretically. Just because that's the case doesn't mean you invest in the top 50. You have to be selective about what you hold, what you choose to hold long term, what you choose to trade short term, what you choose to expose yourself to in terms of the ecosystems. We can't bet at everything. We have to be selective. And if I'm being selective, Cardano doesn't make sense from an opportunity cost perspective. But that's not me shitting on Cardano. I totally get what they're going for in terms of kind of their more academic approach to studying a blockchain, trying to solve issues, going slow, not rushing. Like Solana took that approach where they would just deploy onto the market, break shit, have a lot of downtime, and then kind of see if it worked. Cardano is like the opposite approach. It's like take things super slow, never make mistakes, delay, get everything right. And that could pay off in the long term, but it has been a trade-off in the short term of like getting almost no TVL or DApps building on chain. That's my decision. How about NEAR? I'm actually interviewing Hasib from Dragonfly, a managing partner at Dragonfly Cap tonight. That will launch on either Friday or the weekend as an interview. He is the NEAR expert, so I'm going to ask him a lot of questions. He's a big investor, obviously, which means he probably is biased towards the long side of NEAR. But it will be interesting to hear his opinion on NEAR protocol. So I'm going to kind of leave that response for him because I think he's more qualified to give his opinion. If you want my opinion, I view it in the same light that I view a lot of other L1s. It certainly could succeed. It does have headwinds around the whole DCG stuff at the moment, so its charts look extremely weak. It's not one I'm buying now because I've kind of parked the bus on my riskier DCAs until probably Q1 or Q2 2023. I'm still DCAing into the safer stuff for now, which is ETH, Bitcoin, and BNB, and maybe you could put Matic into that category as well. NEAR as a riskier chain, I'm going to see where things settle. No need to catch a falling knife on this one. Could very well succeed, but it is kind of up against a lot of stiff competition. It does have a sharding approach, which there's been a lot of debate in the crypto community whether sharding is or isn't the way to go. We know Ethereum scrapped their sharding roadmap, the same roadmap that NEAR is kind of following, or the same design model NEAR is following. So it's going to be interesting to see how that plays out. I'm going to ask Hasib the tough questions. I'm going to ask him, why do we need sharding if it is significantly slower than other scaling solutions? What is NEAR doing differently to other chains to separate itself? What is, do you think, the implication of some of its biggest investors going down? Obviously, like FTX, and then also now like DCG. I'm going to ask him all those tough questions, and hopefully by the end of it, we kind of get a bigger picture on NEAR protocol. So of course, and this isn't NEAR exclusive. A lot of protocols were heavily invested in by FTX and Alameda, and that ultimately is a headwind whether they like it or not. Because just think about it: if Alameda gets 1 million NEAR tokens, it only gets like 100,000 of those tokens unlocked on day one because it's seed, which means they're locked. So they vest usually over a 2-year period. And if we look at the supply schedule for NEAR, we can see that that's the case. Over the next few years, we do get token unlocks. Now, if a project like Alameda, and this isn't just about NEAR, I'm just using this as an arbitrary example. Same thing for Solana, same thing for Stewie, same thing for all the other all the other projects that FTX invested in. They do have a lot of locked tokens, and if they need to pay out creditors, what they're going to do over time, we can see the NEAR supply schedule here, is every time they get an unlock, they may be forced to sell, which will add continued sustained sell pressure on a token for an extended period of time. Is the market pricing this in? Well, you can make that argument because a lot of the FTX-backed chains, they've dropped heavily post FTX, Solana being the main one, because people know that FTX is going to be forced to sell off some tokens. So although we will get a sustained kind of drip in supply off a lot of FTX tokens as they're unlocking and they're selling onto the market, because it's what they're going to have to do unless Sam is somehow banking unlocks, which I don't think is the case now that they've been taken over by an official advisor. We're going to see some supply pressure, but there also is like a chance that it is that is already kind of priced into the market, but it's not what I'm willing to risk given the headwinds we've got in Q1. A lot of these projects, I'm kind of just steering clear, seeing what happens. I'm not really in a rush to buy these type of projects. Anything with a headwind isn't really my cup of tea at the moment, basically is what I'm saying. Like, I'm investing my portfolio into more high conviction, stronger narratives, which I can take profits on in the short term, which can outperform versus the market in the short term. The L1 trade being like one of the lazier trades out there, I think that's one that you're not going to see like immediate upside in the short term. And if that's not the case, then there's no rush. Whereas there are protocols which can kind of go against the grain a bit, and you can trade narratives, which kind of ends up being maybe the better approach until we get those really big buy zones next year that we kind of decide to load into some of these more speculative or kind of slower burn projects. And you could definitely put a lot of L1s into that category, depending on your risk profile. Okay. Just checking out a few other questions here. I never liked ADA or Sol. I mean, Sol's another discussion. I've already done a video on Sol. It's got a very robust developer ecosystem, very loyal NFT community. We saw that at Breakpoint. Clearly, it has headwinds, though. So it's kind of a decent proposition long term. It's never getting back to its all-time highs, I don't think. But, 5, 10x, it's possible, maybe even 20x next cycle. But it's going to take like a lot of luck because there are competitors coming out that could steal market share from Sol that you could consider to be better than Sol. But we just don't know until those L1s come out. You got to remember, oftentimes in a bear market, the best performers next cycle aren't the existing projects that ran last cycle. They're actually the projects that launch in the bear market. So a lot of my focus is researching projects that are launching next year that are launching in a bear market, that are well-funded and have good runway, that are obviously going to launch at under market priced valuations because the market's not hot. It's hard to sell out like an ICO on day one in a bear market. What I mean by that is when they launch, retail isn't as hypey behind a certain token. So they don't launch as overvalued. And oftentimes you kind of get a better short-term entry on what can be a very great long-term product. And that's kind of why I'm looking at the next iteration of L1s that improve upon the existing things that the current L1s did really well, and have upside that's greater than the old L1s, which likely ran most of their upside last cycle on off the back of the Ethereum killer lower gas fee block space narrative that was very hot. Does this mean L1s won't run next cycle? No. There are many L1s that will run. It's just not a trade that I'm looking to go super heavy on. I think when you see a lot of people's portfolios, actually, I'd love you to do this, guys. If you have a crypto portfolio, go through and work out what percentages layer ones. Don't include Ethereum and Bitcoin. Separate them. Work out what percentages Cardano, ADA, AVAX, Sol, Phantom, maybe even put an L2, Polygon in there. Work that out. If that's above 50%, chances are you may be too heavy towards L1s. And you may want to consider going either heavier towards DApps or heavier towards interoperability plays or infrastructure plays like bridges and dexes and that kind of stuff, which can certainly kind of give you outsized returns next cycle without as much risk. So what I'm saying is better risk reward, essentially. Just have a look at your own portfolios, because I think a lot of investors, they have this predisposition to investing heavily in L1s and they kind of just think that's the job done. I don't think it is. I think next cycle is very different. And I think you're going to need available capital to invest in newer ones. So keep 20, 30, 40, 50% of your portfolio in stables. And then when there's a new opportunity, use that cash to deploy. There's no rush. We've probably got a solid year here to really position ourselves, stay in tune with the market, see what's launching, see who's innovating, and invest in those products when they launch, because there's going to be some great launches that end up doing what the older ones did last cycle. There's just a few off the top of my head I could give you. I think Say Network has a cool approach. I'd love to see what they do. I think Sui could be a better version than Aptos. If Move succeeds, that could be a decent play. We have the Zero token launching next year. We have a lot of other kind of chains, Celestia. I'll probably do a video on this in the future, but I'm just kind of trying to frame the mindset right now of looking towards these future narratives instead of going so heavy on the past L1s. Even though it's down 80% of devs, what token were you talking about again, Crimson? I forgot. I think you asked that question a few minutes ago. Solana. Oh, talking about Solana. Yeah, I don't think that metric's true. I think if you look at developer activity, most chains have dropped. I mean, it's a bear market. Funding goes down. It's kind of goes hand in hand why developer activity would drop. I'd need to do comparative metrics versus other chains to verify what you're saying. As far as what I've seen from the developer community, I haven't seen a huge drop off. In fact, a lot are actually sticking firm on this thesis that we invested in Solana. We're here, we're at the forefront. We stuck by it during hard times and all the FUD. We're going to stick by it now. And that kind of sentiment has been very present whenever I've spoken to Solana teams. It was present at Breakpoint as well when I went to Breakpoint. So I'd say the developer ecosystem is actually quite robust on Solana. I think the issue is not for current devs, it's for future devs. And the headwind comes not because I think projects will leave, but because new projects that want to launch on a chain may go, okay, let's build on L2 or let's build on Cosmos because, why are we going to build around a chain like Sol when there's kind of like uncertainty around it, right? So yeah, very big future headwind in terms of development, but in terms of current dApps being developed, there are some great ones. I was actually talking to Drift today. They're a good, a nice DEX launching on Solana, order book DEX, like Jordy alluded to. So there are great projects that are already developing and that are going to launch soon, and those are still exciting. So yeah, definitely a headwind, but of course, that's why the price is down, guys. There's a reason why it's at $10 and not at $30 still, because there are headwinds that weren't there a month ago. And that's just the reality of it, and that's priced in now. So if you want to take a bet on that, then you could take a bet on it. If you think it's too speculative based on what's went down recently, you think it's too speculative, that's totally okay. I get the argument for and against Sol. I have a position in Sol. I'm not taking more of a position right now. I might consider it next year, but I don't feel like rushed in December to make huge L1 buys. I feel like there's definitely time here to like scope out a more informed thesis on chains like Solana, which have faced difficulties. So, all right. That just gives you a bit of an insight into what actually happens on the Instagram. So I'm not going to do Instagram today because I do it every day, and I kind of felt like I did it here through a little Q&A. But just so you guys know, in the future, I do that style of Q&A every day on my Insta. So if you like what I just did, answer the questions, give you my thoughts, kind of rebut you guys, talk with you guys, then you can next time, tomorrow's show, day after, etc. Come join my Instagram after the show, and we can kind of do that. Remember, if you want to trade, you can do so on Apex to open the trades that I previously spoke about. I think we're definitely either going to stay in this range or break out. And you might be like, oh, that's not a definitive answer. You're giving us two options. Well, it doesn't really matter, because if you set your stops, we're going to get confirmation either way. That's kind of like the beautiful thing of trading with risk management, right? With actually trading with a stop loss. Caroline Ellison can take some advice from that. All right, cool. It was nice to speak to you guys. I'm going to see you in the next show, which will be tomorrow. We might be covering SBF's extradition to the US then. That's probably got a high likelihood of occurring. If not, I'll line up another juicy fundamental show, maybe on future narratives. I just need to kind of decide where the day goes in terms of news. But until then, I will see you in the next one. Have a lovely day. Peace out.